Welcome to The Explainer. Today, we're diving into a really fascinating friction point in corporate accounting, the branch adjustment account. Now, if you've ever tangled with the stock and debtor system, you already know that finding the true signal in the noise of branch pricing, well, it's like untangling a massive web of internal markups. We're going to skip the basic stuff today and jump straight into the actual mechanics. How exactly do head offices isolate real profits when they're dealing with intentionally manipulated branch stock values? Let's get right into it. So here's the big question. How do you find the true profit when prices are artificially inflated? I mean, this is literally the central conflict of the stock and debtor system. Imagine you've got a head office running several dependent branches. The branch managers out there are doing the daily grind, right? Moving inventory, tracking sales. But the inventory numbers they're looking at, they've been deliberately altered. And head offices do this for very specific strategic reasons. Usually, it's to keep actual corporate margins top secret and to maintain tighter control over those branch managers. But, while that solves a management problem, it creates an absolute accounting headache. How on earth does the head office take these inflated figures and consolidate them to find the real bottom line profitability of the branch? That brings us to Section 1, the invoice price problem, or dealing with inflated prices. To really understand the friction here, we've got to look closely at the dual pricing mechanism that's at play. On one side, you have the actual cost. That's the real foundational cost the head office paid for the goods. But on the other side, we have the invoice price. When inventory gets sent down to a dependent branch, it's not recorded at that actual cost. Instead, it gets invoiced at a higher inflated selling price. And this invoice price basically acts as a disguise. The branch is strictly forbidden from changing this number. Let's make this super concrete. Say the actual cost of a shipment is $100, but the head office sets the invoice price at $120. That $20 markup, that's the disguise the branch manager sees. Because all the branch records are kept at that inflated $120 valuation, calculating a normal true profit margin at the branch level is, well, it's mathematically impossible. They are completely in the dark about the actual margins. So how do we fix this? Let's move to Section 2, the adjustment account and decoding true profit. This is where we introduce the ultimate decoder ring for this problem, the branched adjustment account. This is a highly specific control account, and it's prepared exclusively by the head office under the stock and debtor system. Its one and only job is to figure out the dependent branch's true gross profit, or gross loss. You see, for an independent business, finding gross profit is pretty straightforward, right? You just use a standard trading account to match your actual costs against revenue. But under the stock and debtors framework, a standard trading account totally falls apart mathematically. If you just plug those inflated invoice prices into a regular trading account, your resulting gross profit figure is going to look artificially compressed. So the head office uses this branch adjustment account instead. It bridges the gap between basic profit and loss principles and this highly specialized control environment by systematically isolating that internal markup. Now, the key operational term we need to talk about here is what accountants call the loading. Think of the loading as a phantom margin. It's the exact mathematical difference between that inflated invoice price and the actual cost price. Going back to our earlier example, the loading is that exact $20 markup. The head office intentionally baked this phantom number into the workflow before the goods even left for the branch warehouse. And because the branch's entire inventory ledger is just saturated with this loading, the head office has to meticulously extract it. If this specific variable isn't completely isolated and reversed out, the true historical cost is gone, and the branch's actual gross profit just stays trapped under a thick layer of internal accounting fiction. Which leads us to Section 3, canceling the loading and balancing the ledger. Okay, let's walk through the actual accounting logic of how we systematically strip away this disguise using a T-account structure. We're basically looking at an application of the matching principle here, but applied to internal markups. Let's start over on the credit side. We credit the account with the loading on the branch's opening stock. Why? Because we have to immediately reverse the inflation that was already sitting in that beginning inventory carried over from the last period. That comes straight from the stock reserve account. Next, we credit the loading on the net goods sent to the branch, meaning everything transferred in minus whatever they sent back to the head office. And if the branch reports a stock surplus, the loading on that surplus gets credited here too. By doing all of this, we're basically pooling every single dollar of that phantom profit that entered the branch's ecosystem. Now we have to balance that against the debit side. We debit the account for the loading on the branch's closing stock, shifting it to the stock reserve account so it's ready and correctly accounted for in the next period. But here is the really crucial part. We also debit the account for the loading on any stock shortages. Think about the logic for a second. If inventory goes missing or gets damaged, the branch ledger records that loss at the inflated invoice price. By debiting the loading on that shortage in the adjustment account, the head office effectively neutralizes the inflated portion of that loss. So by carefully recording all these loading adjustments across opening stock, closing stock, incoming goods, surpluses, and shortages, that inflated invoice price gets systematically deflated right back down to actual cost. All right, Section 4, the final profit reveal, finding the true numbers. Let's trace this through the final 4 steps to see how this all builds up to uncover the branch's actual success. In step 1, the loading adjustments we just talked about are made and fully canceled out, which completely neutralizes all that internal inflation. Then, in step 2, once we tally up the debit and credit sides, we get our balancing figure. And this balance right here, this is the actual gross profit or gross loss generated by the branch based on historical costs. Moving into step 3, we take this newly verified gross profit balance and transfer it directly into the branch profit and loss account. Finally, step 4 is where we deal with the real operational realities. Inside the branch P&L, the head office deducts the actual branch expenses. And crucially, this is also where the actual cost of stock shortages gets recorded. You might be wondering, why handle shortages here at the very end, instead of back in the adjustment account? Well, because a stock shortage is a genuine operational loss that actually hits the bottom line. The adjustment account just stripped away the phantom markup on that missing stock. The P&L account is where you recognize the actual hard cost of the lost inventory as an expense against your true gross profit. Subtract those final expenses, and boom, you have your definitive net profit or loss. So this brings us to a really important question. If you don't strip out the loading, what story are your financial statements really telling? I mean, think about it. How can a business effectively incentivize its branch managers if the scoreboards they're staring at every day are intentionally manipulated? If a head office doesn't properly use the branch adjustment account, the reported performance of a dependent branch is just a complete fiction. It's artificially skewed by internal markups and completely divorced from economic reality. Getting true financial clarity means recognizing these friction points and applying rigorous accounting mechanics to separate operational performance from strategic internal pricing. It's a fascinating puzzle. Keep questioning the numbers, and we'll see you in the next explainer.